Most people believe building retirement income requires a massive portfolio and years of patience waiting on quarterly checks. But in 2026, the rules have changed. Today, I'm walking you through a low-stress system that lets you collect a paycheck every single Friday, and you can start with as little as $100. Welcome back. Before I reveal the tickers, here's something important. This is part one of a brand new three-part series. I've spent months studying how the income landscape has shifted, and the old monthly dividend playbook simply doesn't cut it anymore. Also, a heads up, if you've seen older content mentioning weekly ETFs like TGIF or WKLY, stop searching for them. Those funds were shut down and liquidated. They couldn't survive shifting market conditions. That's exactly why staying current matters. Chasing outdated tickers is how you lose money. Here's what this series covers. Part 1, today, safe, government-backed foundations you can sleep well holding. Part 2, big tech weekly ETFs where companies like Nvidia and Apple essentially pay you every Friday. And Part 3, high-octane yield plays for the risk-tolerant with payouts in the 50 to 100% range. Let's get into it. Why weekly? First, is weekly income just a gimmick? Absolutely not. It solves one of the most dangerous problems facing retirees today, sequence of return risk. The biggest threat to your retirement isn't a market crash by itself. It's being forced to sell your investments at the worst possible time, when prices are down, just because you need cash to cover your bills. When you get paid every Friday, that problem largely disappears. You're not liquidating shares to buy groceries. You're living off the income your capital generates, like rent from a tenant, while your principal stays intact. Then there's compounding speed. Reinvesting dividends every 7 days versus every 30 days puts your money back to work dramatically faster. Over a 10 to 20-year horizon, that frequency alone can add thousands of dollars to your balance. Pure math, no extra risk required.
Tier 1 funds. Now, a word of caution before we touch any tickers. A lot of people jump straight to the 50% yield funds and wipe out half their capital in a month. We're not doing that. These Tier 1 ETFs protect your principal with the backing of the U.S. government. This is the floor your lifestyle sits on. Fund number 1, WEEK, Roundhill Weekly T-Bill ETF. WEEK is the gold standard for weekly cash flow in 2026. It holds an actively managed ladder of U.S. Treasury bills with maturities between 0 and 3 months. Treasury bills are backed by the full faith and credit of the United States government, widely considered the safest investment on the planet. Current annual yield, roughly 3.5% to 4.1%, paid every Friday. Expense ratio, just 0.19%, meaning on a $1,000 investment, you're paying less than $2 a year for professional management. Roundhill handles all the buying, rolling, and reinvestment automatically. Put $50,000 into WEEK, and you're looking at approximately $35 to $40 hitting your account every Friday. It won't buy a sports car, but it covers a utility bill or a full tank of gas, and you can count on it with near certainty. Fund number 2, MMKT, Texas Capital Government Money Market ETF. MMKT is a unique tool that every serious income investor should understand. It's the first ETF built to comply with SEC Rule 2A7, the strict regulatory framework that governs traditional bank money market funds. It holds 99.5% of its assets in cash and U.S. government securities. Current 7-day yield, around 4.05%. Expense ratio, 0.20%. Think of MMKT as your emergency fund, but upgraded. Your bank savings account might credit interest once a month. MMKT pays you every Friday. If the S&P 500 drops 10% in a week, MMKT won't flinch. This is where you keep the money you genuinely cannot afford to lose, your mortgage reserve, your property tax fund, while still earning a weekly income from it. Fund number 3, TLDDR, Rex Ladder T-Bill ETF. This one launched in January 2026, and it's worth paying attention to. Rex Shares, the same team behind several popular income funds, built TLDDR to target investors who want to squeeze maximum yield from the front end of the Treasury curve. It holds T-bills with maturities generally under 6 months, slightly longer than WEEK. Projected yield, 3.8% to 4.2%, with a 0.20% expense ratio. The key advantage over WEEK? Active management with more flexibility. If the Fed signals rate changes, the TLDDR team can reposition the ladder faster than a passive fund. Splitting your foundational capital between WEEK and TLDDR is a smart diversification move within the same safety tier. Fund number 4, TSYW, Roundhill Treasury Bond Weekly Pay ETF. I want to be transparent about this one. TSYW is still a Treasury fund, but it carries more risk than the others. It's 1.2x leveraged, meaning it targets 120% of the weekly return on long-term government bonds. Think of it as a leveraged version of TLT. Yield, approximately 2.9% to 3.2%. Expense ratio, 0.99%, significantly higher than the others. Because it holds long-term bonds with leverage, it's sensitive to interest rate movements. If rates rise, the price of TSYW can fall faster than a standard bond fund. This is a bet that interest rates will decline. I treat this as a smaller satellite position alongside your core holdings in WEEK or MMKT, not your primary foundation.
Tax section. Before you put $1 into any of these, you need to understand the tax picture. Weekly dividends are a huge win, but only if you're positioned correctly. These funds pay out interest from government debt, which means it's classified as ordinary income, not qualified dividends. Ordinary income is taxed at your regular bracket, potentially as high as 37%. Keep that in mind when projecting your actual take-home yield. However, and this is a significant advantage, because these funds are primarily composed of U.S. Treasuries, the income is generally exempt from state and local taxes. If you live in a high-tax state like California or New York, that exemption can meaningfully boost your effective yield compared to a high-yield savings account or a corporate bond fund paying a similar rate. So there it is, the 4 foundational ETFs for your weekly cash flow machine: WEEK, MMKT, TLDDR, and TSYW. Together, they provide safety, liquidity, and consistent Friday income that covers your baseline lifestyle without touching your principal. But I know this is just the warm-up. In Part 2, we move beyond the safety net and into big tech income. I'll show you how ETFs like QTDE and XTDE let you own the S&P 500 and NASDAQ 100 while forcing the Magnificent Seven to pay you a weekly dividend that makes a 4% yield look insignificant. We'll break down zero DTE options and how to convert tech volatility into a reliable weekly paycheck. Drop a comment below. Are you still loyal to monthly dividends, or are you making the switch to weekly after today? I read every single one, and your responses shape what I cover next. If this helped you, hit the like button. I'm your host. This is Real Wealth Hack. See you in Part 2.